Good morning dear learners, and welcome you all to the next lecture of my course on financial literacy. This is module number 2, Key Concept of Personal Finance, and lecture number 6, Components of Personal Finance, that is saving and investment. In this lecture, we are going to discuss about the various aspects of saving and investment. In the components of personal finance, we will be going to understand the meaning and the various types of saving that an individual can very easily do while he is earning enough income, the objectives that one must have for saving and various avenues for saving, introduction to the concept of investment and the various objectives of investment, as well as the various avenues of investment in one's life. Basically, in our previous lectures, we learned the various concepts such as financial planning, financial literacy, financial education, as well as the concept of financial well-being. With the understanding of all these concepts, we can very easily understand that starting saving at an early age is very essential for the purpose of creating huge amount of wealth at the time of retirement, when we will be not having any regular source of income. Basically, saving is an act of keeping some money aside after meeting all the necessary expenditures of an individual's life. We all have different kind of financial future goals, and in order to achieve all those goals, we must save today. It is one of the important decisions of everyone's life, as the financial goals and objectives needs to be achieved by managing the finances at the early stage of life, and it also falls under the realm of personal finances. Basically, saving is an act of abstaining from present consumptions for the sake of future consumption. That is a line given by the famous economist Alfred Marshall about the definition of saving. Now, let us understand the various types of savings that a person can do. There are different methods of saving income. We can save the income for a short period of time, and the goals of doing the short term saving may be to meet the various requirements of our day-to-day life. To manage all these expenditure, we can have short term savings. We can also have some long-term savings. With the help of long-term savings, we can meet our long-term objective, such as building a home, education, as well as some other kind of expenditure that needs and require a huge amount of investment. There may be one more type of saving which is known as the backup saving. Backup savings are those that an individual keeps for meeting an emergency or any kind of contingencies that may be involved in their life. The various objectives for saving for different individuals may be different, but in all, we can categorize the various objectives into 3 different categories. Number 1 is for security purpose. We need to have a secured financial future, and that is why we need to save at an early age so as to meet any financial contingencies in the future time. So, for meeting the unexpected contingency, one must have enough of savings so that the various needs of the futures can be met very easily. For financial support also, some persons save in their life for providing them financial freedom as well as attaining them a state of financial well-being. We must save enough amount of income for the purpose of meeting the various other kind of expenditures which are not of regular type. For retirement planning also, one must save in their life to ensure financial security after retirement by contributing into the various retirement accounts such as 400k, IRAs or pension fund. The goal is to maintain a comfortable lifestyle at the age when you are not able to earn sufficiently to meet your livelihood expenses. So, relying solely on one source of income and not saving enough may be dangerous for one, and for the various purposes such as security, for having a financial support, as well as for the purpose of retirement planning, one must save at an early stage. The various avenues for saving enough amount of fund in one's life may be fixed deposits, mutual funds, gold, national saving certificates and senior citizen saving schemes. These are the most commonly opted avenues for savings, with the help of which we can very easily save some amount for our future expenditures. Now, let us discuss all these avenues in detail and their characteristics so that we can understand which one is better and how we need to save enough for the future. The first one is fixed deposit. A fixed deposit is basically the most popular or traditional ways of saving money, especially among Indians. It is considered as one of the safest method where one deposits their surplus amount of income into a bank account and they, after a fixed period of time, receive their money with interest from the bank. However, withdrawal is not possible from a fixed deposit without the expiry or maturity of the fixed deposit time period. The key features of fixed deposits may be the fixed tenure, fixed interest rate, as well as it also involves a very low amount of risk. So, it is very safe and one must save in such kind of investment avenues to have regular amount of income and who are basically risk averse in nature. The next avenue for the investments are mutual funds. Mutual funds are a very popular method of the security market where one can invest their money into various types of mutual funds and they can equally very easily participate into the security market without taking extensive risk as well as without taking extensive knowledge of the security market. A mutual fund is an investment vehicle that pools saving from multiple individual investors in the market and it is invested into the security market. The money in the mutual fund is basically managed by the experts and as a result mutual funds diversifies your savings into multiple kind of stocks investments so that they can lower the amount of risk that needs to be bear as well as high professional management is provided and hence regular return is promised under the mutual fund schemes. The key features of mutual funds are it basically procures the fund from small savers of the money. It is managed by experienced fund managers who make the investment decisions based on the market analysis and research and it helps in reducing the risk by investing the various types of assets rather than relying on only one type of investment of stock or security in the market. Now, the next type of saving avenue may be gold. Purchasing gold is one of the oldest habit as well as the traditional way of saving which is highly liquid in nature. Gold is highly liquid investment that also allows you to save your money and get it back whenever you require it without wasting a single minute of time. It is highly liquid in nature, it is universally accepted as well as to create a wealth and to store a value, gold may be a very good option for the individuals. It is quickly marketable and hence the liquidity is very high. Whenever you are in an urgent need of cash, you can very easily sell it to the another person as the acceptability of the gold as an investment is very high in the market. Next investment avenue is the National Saving Certificate. National Saving Certificate schemes are the schemes of Government of India. These schemes are announced by the Government of India primarily focused on small income savers of the country who are having a very limited surplus money with them. One can open an NSE account at a post office and they can invest their money for a fixed period of time into these investments avenues and the money can be withdrawn only after the expiry of this particular NSE. So, before the maturity period when one cannot withdraw their money or savings from the National Saving Certificates, but this also guarantees the regular return and safety of the principal amount to the savers of the money and hence it is also a very popular method of saving in our country. Next one is the senior citizen saving schemes. These schemes are basically designed for a age group of people who are more than 60 years or older people. Basically, it requires a very less amount of money for the purpose of investment, such as 1000, and we can very easily opt the various schemes that are available under the senior citizen saving scheme, which are initiated by the government of India. So basically, these are designed for the older age of people who at the time of retirement some kind of saving avenues where they can have a high amount of security as well as regular returns also. Now with this we can very easily understand that savings are a very important part of our life, and it is essential that after assessing our total income and estimating our total expenditure, we must try to save some amount for our future expenses, and we can utilize all these different saving avenues that I have discussed, such as fixed deposit, mutual funds, gold, saving certificates as well as NSC certificate. And with the help of saving into all these avenues, we can very easily have some money for our future expenses. But suppose that if one save a fixed percentage of their income but do not invest it into the market, what will happen? Now there is a concept which is known as purchasing power concept of money and opportunity cost. Due to these concepts, the value of the money will deteriorate after a fixed period of time. So it is very important that to earn sufficient revenue on the money that is saved by you today, you must invest it into the market so as to earn sufficient revenue for the passage of time, or which is known as the opportunity cost. Now let us understand the second key concept of the personal finance, which is investment. Investment is also a very important part, because if you save your money but do not invest it into the profitable avenues, obviously you will lose the opportunity cost on the money saved, and hence you will have no profit and you will not be able to create wealth for the future. Basically, investment simply means putting your money into something that not only preserves your principal but also give you some return at the end of the time period. According to the various famous economists such as Benjamin Graham, investment is the commitment of fund to assets that are expected to generate return over a longer period of time. According to J.M. Keynes, investment is the act of spending money with a view to earn more money in the future. So, the second concept of the personal finance, that is investment, helps you to understand that without investing your money into profitable investments, your saving may become worthless, and it may simply put your money into something that will give you no return after a certain expiry of time. So keeping your money idle is useless, as money loses its value over a period of time. Now let us understand why different type of individual invest their money into different investment avenues. So the first one is for the purpose of capital growth or wealth accumulation. Capital formation or capital growth is an objective whereby one individual invests their income or their saving for the purpose of earning something on that amount of money. So that appreciates the value of the principal amount or the saving that one individual is investing into the various investment avenues. So it increases the value of the saving over a period of time, and hence it helps into the capital formation. So various examples of capital growths are investment in stocks, mutual funds or real estate. By investing into all these different investment avenues, you can very easily analyze that the investments will always help you to have some wealth accumulation or the capital growth over a period of time. Some people may also have some different objectives of investing their money into different investment avenues, such as getting the tax benefit. So for the purpose of tax efficiency also, some individual may invest their money into various types of investment avenues. Basically, there are various types of investment avenues available, such as insurance products are there, NSC certificates are there, public provident fund is there, that provides you the benefits of various types of income tax reliefs which are discussed under section 80C and various other sections. So for the purpose of having these different kind of tax relief, one may invest their money into life insurance scheme, into general insurance scheme, into PPF, as well as some other kind of investment avenues that are available that helps you to get the tax advantages that are offered by the Government of India according to the income tax law of our country. The next purpose for any individual for investing into the investment avenue is the hedging. Hedging is basically the process of investing into an asset that may help you to mitigate the risk that is associated with a portfolio. Whenever you invest your money into a highly risky investment avenue, you need to have some secured funds with you so that the risk of losing your money can be minimized. So hedging is a process whereby saving into some effective investment tools, you can very easily manage your risk. So with the help of investment into a diversified portfolio, where in one investment avenue you may have regular source of return, as well as in one where there are highly risky investment avenues, you can very easily manage and hedge the risk involved into the investment procedures. Now, some people may also have some different objectives of investment, such as having financial security in the old age. So, in the old age, for the purpose of having a financially secured life, we must invest into some kind of investment avenue where we can earn some regular return and we can accumulate enough of wealth when we will not be able to work. So the old age security provides you a financial cushion when you will not be able to work and earn a sufficient amount of income to meet your various types of livelihood expenditures. So these are the various types of objective that any individual may have for the purpose of investment. Now, let us discuss what are the different types of investment avenues that are available into the market where we can invest our saving and we can earn enough amount of return from our money that we have saved with the help of managing our income and our expenditure. So, let us discuss all these different avenues of investment in detail. So, the various investment avenues may be discussed as stocks, then money market instruments, then various other types of instruments such as bonds and real estate. Now, let us first discuss about the stocks. Stock basically refers to an investment in the shares of any company where we can invest into the equity shareholding or the preference shareholding of the company depending on the ownership basis. When by purchasing shares of a company, we invest our money and receive dividend from the company as a part of our return, then investment in the stock becomes useful as well as a very profitable long-term investment for us. Investments into these stocks may be of two different types. One is known as the equity share capital, whereas the second category is known as the preference share capital. Equity shareholders are basically the owner of the company. They do not have any preferential rights in the profits of the company, but they do have an ownership right into the management of the company depending on the total amount of their shareholding into the company. However, it is a riskier type of investment because shareholders will not receive any dividend, and only when there are sufficient surplus profits with the company, then only they will get a share of profit from the company. So they need to make compulsory payment obligation towards the company, but they do not have any preferential right. Whereas the preference shareholdings are the various types of investment avenues where the investors has a preferential right over the payment of dividend, repayment of capital at the time of winding up of the company or at the time of redemption of the share. However, they do not give any kind of ownership or voting right into the management of the company. So, these are the various types of investment into the stocks, that is the equity share capital and the preference share capital. Now, there are some other types of investment avenues which are done for the purpose of investing into the market for a short period of time. So, for the short period of time, we can invest our money into the money market instrument. Basically, these are short term investments that are done usually for 1 year of time period. So, money market instruments are the wonderful ways to invest if one wants to invest for a short period of time. So, there are various types of instruments in money market such as treasury bills. Treasury bills are basically short term money market instrument that is issued by the central banking agency RBI on behalf of Government of India at a discounted rate from the face value, and at the time of maturity the investor will get back face value as the maturity amount. Certificates of deposits are also theirs. These are the deposit certificates that is issued by the banks when a consumer deposit their money in the bank, typically when they have any surplus funds with them. Then there are commercial papers are also available. These are issued by the reputed companies to raise funds from the general public on which they pay some interest to the public. Then there are public deposits. These are also a type of deposits that are raised by the company as a debt instrument. So, they have a fixed tenure during which the depositor cannot withdraw their investment from the company. Until then, the depositor will receive interest as a part of their return. Then we can also invest our money into real estate. Real estate basically refers to the investment whereby we invest our money into the physical assets such as land or building. The value of investment in real asset basically normally appreciate over a period of time, creating capital appreciations for the investors. Then we may also invest our money into the bonds. Bonds are basically creditorship securities, that is the investor gets a creditorship into the company, as well as for a fixed period of time their money will be given to the company for the use, and in the return the investors, the creditors will get interest from the company. The various types of bonds may be divided into the government bonds, corporate bonds or municipal bonds. So, at last we can very easily say that not only saving is important, but investing it into profitable investment avenue is equally important for every individual to have financially secure future. So, to conclude, I would like to say that you must save enough for your financial well-being, as well as you must invest it into the profitable investment avenues depending on the objectives of your investments, as well as a proper market analysis and research. With this, I would like to conclude my today's lecture on the key concept of personal finance, that is the investments and saving. Thank you.